Welcome to our April meeting. I'm going to make a couple of brief announcements. My name is Lynn Chalel. I'm the president of the Silicon Valley chapter. And after some brief announcements, Bill Jump will take over, introduce our speaker, and then we'll be off into our program. We're looking for a great meeting today, and I'm going to turn the time over to Bill Jump.
Okay. Good morning, all. I'm very pleased that we were able to get Jim Lebenthal. He's an outstanding guy. He was a lieutenant in the Navy and qualified as a nuclear submarine engineer in the United States Navy, where he was awarded 4 Navy Achievement Medals. He has a BA in molecular biology from Princeton, an MBA from the Wharton School of Business, and has achieved a CFA Chartered Financial Analyst designation. He's the CIO of Cerity Partners that provides a broad-based set of comprehensive financial services, New York, Boston, Silicon Valley. I think they've got about 18 offices. And we have an office in San Francisco, close to us. More information is at CerityPartners.com, and Jim will give a brief overview of the firm. He's, in my experience with Jim, is he's a very sound portfolio manager, CIO of Cerity Partners. He appears regularly on the CNBC halftime show, and his family has a long history in muni bond investing back to 1925 in New York when his grandfather started the business. So he grew up at the seat of some investing folk. In his presentation, he'll cover steps and criteria for stock selection, building a sound portfolio, provide a market outlook as we see it now, and how his portfolio reflects that. He'll cover fundamental analysis and how that's used to arrive at a stock value, how to develop a portfolio across style, market cap, sector, and tactical positioning, and how to make an assessment of the market environment and how it relates to a portfolio. In summary, I have great respect for Jim. He's a very sound investor, and he's speaking to us from New York. Please welcome him. Jim, it's all yours.
Okay, Bill, thank you. And thank you for that wonderful introduction in particular. Really, I should talk to you every day and start my day with that sort of introduction. Thank you. But also thank you to the group for attending today. I'm really delighted to be presenting, both because of the investment intellect that the group represents, but also because, as Bill noted, I do appear on CNBC quite often. And on CNBC, you have about 15 seconds to make your point before they move on. And this gives me a little bit longer format with you today to explain how I'm looking at the markets and how I value stocks in general. So again, thank you for that. There's 3 things I want to do with you today. One is just tell you a little bit about myself and the firm, and I really stress that's going to be the small part. This is not a sales pitch. The other 2 things, I want to talk about the state of the financial markets right now. And then I want to go through a little bit of how I look at stocks individually, as Bill said, how I value them. At the end, I'll leave room for Q&A. So if you don't mind, I'll leave plenty of room at the end. So please wait the questions until the end. Thank you. Okay. So starting with, as I said, I'd go through the Cerity Partners description. Maybe before I do that, a few more salient points on me, highlighting what Bill already pointed out. I literally grew up in the investing business. My family ran a municipal bond firm that was started in the 1920s. I'm 53 years old, which means I grew up in the hyperinflationary 1970s. And I can remember feeling that in the form of comic books, which I'd go ride my bike down to the newsstand every month, and I'd see the price of comic books go up every month. That left a memory, memories that were also associated with double-digit interest rates, which could be good for an investor, triple tax-free double-digit interest rates on municipals, but also remembering things like the stagflation of the 70s, issues, geopolitical issues like with Iran from the 70s into the 80s, oil, et cetera, et cetera. My first career was in the Navy. I loved it, absolutely loved being a submarine officer. Short story is the Cold War ended and I moved on. However, my first investing experience was in 1980, 12 years old. I asked my father for two companies, US Shoe and Texaco. I had the bug at an early age. I realized you can put your brain power to work, evaluating businesses and their share prices, and you can make money from doing it. So I've been doing it for over 40 years now. After the Navy, when the Cold War ended, I decided to take that love of stock picking and make it my actual business by advising clients. I did that first at Goldman Sachs, then at my family firm, and I've been at Cerity Partners for 5 years. I have to say that outside of the Navy, this is the happiest I've been in my professional career at Cerity Partners. I'm leaving up here some salient points. You can read those, obviously. I want to go through this quickly, as I said. These are some of the things that we do. So while I am an investment manager and a stock picker, there's obviously a lot more that goes into wealth management. You have this presentation so you can review these things at your leisure. We're a well-decorated firm, a lot of people with a lot of credentials. As Bill pointed out, we are across the nation. And I want to talk to you a little bit now more deeply about how we look at managing investments. Okay. I'm going to go through the next couple of slides also pretty quickly because I really want to make sure that we spend our time on the meat of this topic, which is the financial markets and how we should be picking stocks right now. But these are some of the high-level things that we think about in working with individual clients. Bill mentioned he called me the chief investment officer. I'm actually our chief equity strategist, which really means that I'm primarily focused on the public equity markets. We have a chief investment officer who blends my thoughts with what we should be thinking about other asset classes as well. I'm getting to the heart of the matter here. Forgive me if I just skip through these pretty quickly, because this is the slide that I really want to start on, okay? Now, I mentioned to you twice already, I'm 53 years old. Why do I do that? Because I'm going to say something in reflection of this slide that if I were 33 years old, I wouldn't have the authenticity with which to say it. This slide, which is a 100-year chart of the S&P 500, picture is always worth 1,000 words. This screams to me that your right answer is to stay invested. Okay. Now, for those of you who watch me on the show, I've been accused of being a permabull and always optimistic. I don't think of myself as a permabull, and I don't think of myself as some Pollyanna or somebody who's been taking nitrous oxide when I look at the markets. I do think about this slide, and I think about all of these terrible events that occurred, and yet the stock market goes from the lower left to the upper right. That tells me that the right answer for almost all of us is to get invested and stay invested. Later on, I'll prove this or show this in a different way, that it's really your time in the market, not timing the market, that matters. But there's an important secondary point to what this chart is saying. In order to get through those downturns, like the Lehman Brothers bankruptcy, just to point out, that started the great financial crisis. In order to get through those in the markets, you have to be in quality companies. Now, beauty's in the eye of the beholder, okay? Quality company will mean something different to each investor. To me, what it means is profitable companies with excellent proven management, moats to competition, and strong balance sheets. These are the companies that you can hang on to through the downturn. Okay. Having put that out there as an overarching viewpoint, I want to talk a little bit more deeply about equity portfolio management and where we are right now. After I speak, Bill's going to present a little bit more on the state of current affairs. I'm looking forward to listening to that, Bill. As I mentioned earlier, I do feel like I'm accused of being a Pollyanna, but I'm not. I look at the negatives as I see on the left-hand side here, and I look at the positives and I balance them. And when I balance them, I come out as on the positive side of them. And I do want to point out one interesting thing. I've used this slide in presentations since the beginning of the year. And when I look at those concerns, the bricks in the wall of worry on the left-hand side, I will tell you that their importance has moved around a lot in just 3.5 months. At the beginning of the year, it was the Fed. A month ago, and I still think now, it's geopolitical risks. But the Fed's coming back up, as the market adjusts to a lot of hawkish talk. And my point on this is that things change, but your investment plan and your ability and the way that you manage equity investments can't change in response to every shift in the way the wind blows. That's an important point. Let me continue on here. This is a theme that I've been consistent internally and publicly in saying, which is saying that the year we're in right now, 2022, is a return to normal. What does normal mean? It means lower equity returns than in the past 3 years in particular, but really the past 10 years. I'll show you some numbers on this a little later, but the 3 years that ended December 31st, 2021 had an annualized return in the S&P 500 of 26%. Folks, that's above normal. I'm sorry. And it's going to feel lousy when we come back to more normal returns like we're going to get this year, but they're still going to be positive. And I want you to really focus on that they're still going to be positive. And yes, the volatility is, as we've already seen in the first 3.5 months of this year, going to be higher. So if I'm the pilot of an airplane and we're traveling somewhere, this is the point in time that I turn on the fasten seatbelt sign and I ask you to just buckle your seatbelts and get through it. The plane's not going to crash. I don't think the plane's going to crash. I think I'll make a side note here. The business that we're in investing is about predicting the future. I know there's times that I speak with certainty, as I will in this discussion, but I do want you to know that predicting the future has inherently uncertainty, and there's no way anybody can do it with complete confidence. Forgive me, therefore, if my tone is confident. I have done my work and I'm confident in my projections, but I acknowledge they are projections and that the future may turn out very differently than what I see. But that said, I am telling you, we're going through air turbulence. The plane is not going to crash. Okay, let's dive into that a little bit further. Okay, 2 charts on this page. I'm going to start on the left one, but while I'm talking, you may want to read the right chart because, boy, that's an important one. What I'm showing you on the left side is that this is a chart of the S&P 500 versus its 200-day moving average. And that period of time from the middle of 2020 until the beginning of this year, that the S&P 500 resided above its 200-day average without even touching it once, is unusual. It's not unheard of. It's unusual. It was a very quiet, serene time in the markets. It was courtesy of the Fed and all the bond buying they were doing, which was injecting cash into the system. And because that force has removed, we should expect volatility to continue. But however, I do want you to notice that the S&P 500 went well below the 200-day moving average. It's, by the way, this is a little dated and I apologize for that. It's now right on the 200-day moving average. For it to go meaningfully below the 200-day moving average the way it did, and for it to stay there, requires a crisis that, in my opinion, is bigger than what we're in right now. It requires a crisis like the great financial crisis. It requires a crisis like the pandemic-induced shutdown of the global economy. That's not where we are right now. The worries that we have about an aggressive Fed are not a crisis at that level. Now, further continuing on with the slide on the right, I want to put both of these together, and I want to say to you, please don't try to time the market, because consider over the 20-year period that's represented in the chart on the right, if you missed the 10 best days. 20 years of trading is more than 4,000 trading days. If you missed 10 of those trading days, your average annualized return is cut in half, more than in half. That's not a risk I'm willing to take. When I listen to people in the media talk about raising gargantuan levels of cash, I think to myself, boy, you are playing with fire. And consider the blurb that's in there that indicates that not only do you not really know when those 10 best days are going to happen, they actually have a higher likelihood of happening after or near to the 10 worst days. The point being is that when it looks the darkest, that's when I really want you to buckle your seatbelts and get through the air turbulence, please. Okay, let me continue on here. I said I was going to reference this earlier. Okay, couple of things to think about here. You can take a look at the 3-year chart or 3-year numbers. You can take a look at the 10-year numbers. Either way, the S&P 500 return over the past many years has been well above the average. The 20-year average, as you can see, is 9.2%, and that actually is close to the very long-term average. And that's what we should expect going forward, is roughly 9% returns. Why? Because the Fed is removing accommodation, which means multiples are going to have a very hard time expanding. So what you're going to get from the stock market is the growth in earnings per share, which is roughly going to be around 9%. And that may feel really lousy, as I said earlier, compared to the 20% plus, as I said, 26% if you measured it over the 3 years ended December 31st. I know it's going to feel lousy to come down to 9%, but that's the norm, and it's not that bad. And by the way, if you compare it to the 10-year Treasury at 2.7%, and that's the high level, that's a 3-year high level that we were at yesterday, it obviously compares pretty favorably. So I hate that expression, there is no alternative, Tina, but the point is being made that there is no alternative. Okay, now, I've been saying to you that I'm optimistic. And I've been saying to you that I'm not a Pollyanna. Okay, let's prove it. Let's prove it that there's actually data behind this. Let's start with what's going well. Earnings are the lifeblood of the stock market. Everybody knows that. They've been being revised higher. By the way, I apologize that this is a March 10th update. As of March 31st, earnings on the S&P 500 are still being revised higher. Now, we will get an interesting tell in the coming weeks as earnings come in from individual companies, and we will see if these analysts are wrong or if they're right to continually raise earnings. For those of you who don't know how to read this chart, and I'm gonna make it a little bit more clear in this longer term chart, this is an indication of how analysts are looking at earnings over a period of time, meaning what are their estimates of future earnings doing over time? To the extent that these squiggle lines, as they are called, are going up, that's an indication that they think earnings are going up. Now, I want you to note that in the last decade, those earnings estimates most of the time went down. They went down over time. So analysts started out too optimistic and then they got more pessimistic as time goes on. That's what a mid to late economic cycle looks like. What an early to mid economic cycle looks like is on the right-hand side where you see 2022 earnings and 2023 earnings rising as time goes on. And I do want to point out that whether it's the March 10th that I'm referring to here, or as I said, the March 31st numbers continue to rise higher, that this is after Russia invaded Ukraine. This is after oil spiked to $100, $130 on West Texas Intermediate, after nickel spiked to $100,000. So that is priced in as well. Okay, let me continue on here. Now, okay, so why are earnings not declining? And I'm going to give you a few indications of that, but basically it's because the US economy, folks, is in great shape. Let me pause for effect and repeat it. The US economy is in great shape. Anecdotally, I can recall being on the Santa Monica Pier in February around President's Day before Russia invaded Ukraine, and I could not move. I could not move. There were so many people out and about. And I thought to myself, boy, I wonder if this is going to change if Russia invades Ukraine. Well, the answer is in this chart. There's absolutely no let up in air travel, which is what this is. This is the TSA traveler count through airports. Absolutely no let up in response to Russia, Ukraine, which, kind of makes sense. Side note, I don't want to be blasé, and I certainly don't want to appear to be crass. I'm in the business of investing. I'm in the business of trying to make money for my clients, giving advice to folks like you as I'm doing now. The Russia-Ukraine is a terrible, awful tragedy. I really, and I don't want to bring tears to my eyes or yours, but it does make me weep, literally. I'm going to leave it at that because the point here is not to be a moralistic or sob story discussion. But I just want to address that because as I'm talking about making money, I'm not blind to what's going on in terms of human tragedy in the world. I'm going to continue on here, though, and show that these are Las Vegas hotel room rates and visitor counts. People are going to Vegas, folks. People are out. They're having a good time. Jobs are plentiful. Average hourly earnings are growing. The economy is growing. People are out. They are consuming. The fears of an economic slowdown have not yet showed up. And why is that? Why is the economy booming? Well, because there is an awful lot of corporate CapEx going on. Semiconductor plants being built all over the country, electric vehicle plants being built all over the country, new mines being opened, whether it's for rare earth elements in California, whether it's uranium in Wyoming. And those mines are going to produce ore that has until now been refined overseas, but is going to now be refined in the US. We are re-onshoring supply chains. It's a response to events over the last 3 years, and it is going to continue. It's going to be augmented, by the way, by infrastructure spending that has already been approved. So this is what is going to drive that economic growth, jobs, average hourly earnings going up, industrial production. This is what's going to drive economic growth for the next few years to come. And an analogy that I've recently made is for anyone who exercises and likes to run. You know when you're getting winded because you look down at your feet. When you're in good stride as a runner, you're looking out on the horizon. I submit to you that if you are overly worried about the Fed and interest rates, you're looking down at your feet. This slide is what I want you to think about when I say, please look to the horizon, keep that strong-winded stride. Okay. And also, in a second, I'm going to get into some individual stocks, but I do want you to note that valuation on the markets has come down from the beginning of the year. Okay, so let's start talking about areas of the stock market that I think are attractive right now. Inherent in what I was just saying about economic activity, corporate capex, and the like, is the belief that we're early to mid in the economic cycle, and you should be exposed, overexposed, but not exclusively exposed, as I'll show you. You should be overexposed to cyclically sensitive sectors like financials, energy, industrials, and materials. I think the reason for that is somewhat self-explanatory, but you can review these reasons here. Continuing on with what I would avoid. Listen, it's probably no surprise to any of you who know me that I really do place a premium on cash flows. Remember what I said earlier in looking at that 100-year chart of the S&P 500, that to make it through downturns, you need companies that are profitable with moats to competition, great balance sheets, good managements. And what I'm really trying to show on this chart is that when you look at some of the more innovative companies, as represented by the ARC Innovation Fund, and folks, I'm not taking shots at Kathy Wood, I don't care. I'm just using it as a description of a pocket of the market that is innovative companies that generally have negative cash flows and generally need to go back to the capital markets to enhance their future growth. That is difficult to do if you're in a rising interest rate environment, courtesy of the Fed. Now, do you want to make a point here? I do own, for myself and clients, a few of these transformative companies. One would be Twilio. Another would be Salesforce and PayPal, although those two have positive earnings, they're just rather expensive. My point is not that you shouldn't have any innovative companies in your portfolio. It's a comment that the degree to which you have them in your portfolio matters. For me, it's less than 5%. So I have a toehold. Okay, but it's not where I think the market returns are going to be generated in this calendar year. So I've already said, very much like economically sensitive stocks, I'm very suspicious of those stocks that are innovative but don't have earnings. And that leaves our beloved FANG stocks and large cap tech. And I know I'm speaking to Silicon Valley, so I know this is probably a part of the market that's very near and dear to this group's heart. I'm not negative on these stocks, folks. I'm neutral. That doesn't mean bad. Doesn't mean bad. It means that I think these stocks for the next year, 2 years, are likely to grow at the rate that the overall market grows. I bring up here 2 of the bellwether stocks, Microsoft and Apple. You can see that these are, or rather that these are the 2 largest stocks in the stock market. And what I want you to note on this 5-year chart is that their share price absolutely trounced that of the S&P 500. Now, why is that? And the answer is, it can be shown on the next page. And I know this is a little bit involved, so let me try to guide this a little bit. Look at in the middle here of each presentation, look at the historical 5-year compound annual growth rate for earnings per share in these companies. Pretty breathtaking. Okay, breathtaking. Apple at 21.95% annualized earnings per share growth over the last 5 years. Microsoft at 30.8%. I mean, this is fabulous. They're fabulous numbers, but they're still below the rate at which the share price increased during that time frame, as I showed on the earlier slide. Why is that? It's because the multiples expanded, which you can see in the top line for each of these 2 companies. You can see that the multiples have expanded over the next 2 years. And what I would say to you is I don't think it's likely that we're going to continue to get that multiple expansion as the Fed raises interest rates, number one, and as that earnings per share growth slows, as you can see in the 3-year projections, you're just not likely to get multiple expansion. So what you're likely to get is share price growth for the FANG stocks that's roughly commensurate with their earnings per share growth. And that's fine. If I give you 9% on these stocks, we should be happy. So that's why we're neutral on these areas. And this slide is just another way of saying to you that this is in the coming year, we think we're going to get earnings per share growth, but not multiple expansion. Okay, what I'd like to do, and I just want to take a look at the time. Ooh, I'm moving a little faster than I thought I would. Okay. What I'd like to do here is just go through a couple of stocks that are in the portfolio that I run, so-called private client portfolio. One is Wynn Resorts, the other is Qualcomm. These are 2 stocks that I've spoken about often on CNBC. And I want you to know how I look at these 2 individual stocks and why I'm bullish on them right now. And then we'll leave plenty of room for Q&A afterwards. Okay, let me start by saying this. When I look for a stock, I'm looking for something that is mispriced in the market. This is what wakes me up and excites me every morning, is to wake up and say to myself, where is there $1 worth of value selling for 50 cents? I love it. And I think it's out there every day. And I just have to find it. And I also have to be patient when I find it, that maybe the market takes a little while to respond and react to that value. This, by the way, that thought process is what got me going at the age of 12, and it gets me going every day today at the tender age of 53. Okay, so how does that apply to Wynn Resorts? Wynn Resorts is a casino company. It has U.S. operations and it has Macau operations. I showed you a slide on Las Vegas fundamentals a short while ago. I will tell you that in August of last year, I was out in Las Vegas and I was blown away. I'm not being, I'm not using hyperbole when I say I could not move down the street. I know I said that about the Santa Monica Pier. I meant it when I said that then, and I mean it when I say this. I was out in Las Vegas and you could not move. This was with the mask mandate in place. People were out, people were spending. Again, it's a reflection of a strong economy that is likely to continue. But Wynn's stock price has been terrible recently, absolutely terrible. So why is that? Well, I mentioned that they have Macau operations. You're probably very well aware that China has been cracking down on corporations, including possibly putting some restrictions on Macau operations. So that is what has knocked the stock down. However, at its current valuation, using a sum of the parts analysis, I would submit to you that its enterprise value is actually worth the U.S. operations of Las Vegas, and they also have a Boston operation, that those US operations have been and will continue to exceed expectations, and that Macau simply represents a zero cost call option embedded in the enterprise value of this company. So let me just say that again. You're getting a company that, in my opinion, is undervalued on the US operations. And if anybody's been to Vegas, you can probably see that for yourself. And by the way, room rates, Wynn Resorts, are up triple digits over 2019 levels. Okay, they're raking in money. But the zero cost call option embedded means that if anything goes right in China, you get a pop in this stock. And right now, the market thinks that nothing will go right in China and Macau. Maybe it's right. Okay, then we've got the US operations. But watch out for this stock if, as actually has happened over the last couple of weeks, China starts making some noise, that it's going to be a lot less harsh on Macau operators. Okay. I also want to talk about Qualcomm. If you've watched me on the show, you've noticed that I think quite highly of it. Look at that share price graph over the last year. Man, that is one schizophrenic stock, isn't it? It's down, it's up, it's down. Okay, folks, this is what's going on with Qualcomm. Qualcomm has perennially been undervalued. Now, perennially, I mean over the last 10 years. If you go back 25 years, it was not undervalued. But over the last 10 years, perennially undervalued. It gets at best 15, 16 times multiple. You can see right now it's around 12 times this year's earnings. I mean, that is an incredibly punkish valuation, which can be seen in the PEG ratio over here of 0.8. For those of you who don't know what a PEG ratio is, it's the price to earnings ratio divided by the growth rate of those earnings projected over coming years. And folks, if you just listen to the last earnings call from Qualcomm, they're likely to grow earnings well over 30% this year. You're getting that 30% growth rate for a multiple of 12. What is that? That doesn't make much sense. There's a reason for it. The reason is the market is very concerned that Qualcomm is overexposed to smartphones. That's where traditionally they have made their business. And in particular, they're worried that Qualcomm is overexposed to Apple, which has made a lot of noise about insourcing its mobile telephony chips, which it currently gets from Qualcomm's. Okay. All right, that's a legitimate risk. That would be a legitimate risk for which to have a low multiple on the stock. But last earnings call, Qualcomm made it very, very clear that they have diversified, not are going to diversify, that they have diversified. They have diversified strongly into Android operating systems over Apple. And they have strongly diversified into automotive applications and Internet of Things applications, so they're not as beholden as they have been traditionally to the smartphone markets. That news, by the way, is why the stock popped up here at the beginning of the year. What's happened since is it has trailed off on concerns about supply chains, concern about the war, concerns about economic slowdown. But what history and experience as a stock investor tells me is that when a company goes through a transformational change in its earnings power, as evidenced at the last earnings call, when that happens, it usually takes a few quarters of consistent execution on that new model before the market really, truly believes the company. And we're really only one quarter into it. So for me, this looks like a very good buying opportunity in Qualcomm, as I expect the next few quarters to continue that transition into a very diversified earnings stream. And again, at 12 times earnings, 0.8 times PEG ratio, even a dividend yield, I look at that as very attractive. Now, that's actually all of my prepared remarks for today. I'm going to put us back up at the top because I always like to have a just a title page for us to have up on the screen as we go into Q&A. Bill, Celia, I'm not sure how you'd like me to take the Q&A. I could read the chat questions, or I can just open it up. How do you usually do the Q&A?
If you could read the chat questions, that would be awesome.
Okay. All right. Well, Not many chat questions. I'm sure they're going to start popping up here. So questions can be entered into the chat at any time. Presentations found on the website. I'm sure you guys all know that.
All right, I can do that.
And okay, this Carl Close. I want to simplify my portfolio by reducing my individual stocks and putting most of my portfolio in broad index funds. I haven't decided the mix between index funds and individual stocks. How is this portfolio question different? How's this portfolio question, just trying to scroll down here, different than a portfolio of just funds or just individual stocks? What principles do I need to consider foremost? Okay, I love that question. I love that question, even though I'm an individual stock picker, because, and I'm going to go back to the chart. All right. Thank you for this. You know what chart I'm going to? This one. I want you invested. I don't care if it's passive indexes or if you want to believe me on Qualcomm, be invested. I do not try to convert people from active to passive, passive to active. But this chart screams to me, and I hope it does to you, that it's time in the market that matters. I would suggest to you that a very good way of investing is the S&P 500 depository receipts, ticker is SPY. You can also use the Vanguard version, which is VOO. That will give you the S&P 500. And as I said, we should expect a return to normal returns for the next few years of 9-ish%, 9 to 10%. Take it, get it. Now, an active manager like me thinks that by picking Wynn Resorts and Qualcomm and maybe underweighting other stocks that he can beat that. Proof will be in the pudding, but I really want you to be invested. And I'm going to make the point again. Please humor me, and thank you for humoring me, by the way. I want you to look at this right-hand chart. Oh, shoot, where did it go? There it is. I want you to look at that right-hand chart. Please don't try to time the market. Please get into the markets now. I understand my saying don't time the markets may be a little hard for people who say, well, I got cash right now and I'm not sure. I mean, look what's going on in the world. And Bill's going to talk more about that in a second. Look what's going on in the world. Should I really put it all in now? As an advisor with clients, I hear that all the time. I get it. I feel it. So here's what you do. You set a plan to get invested and you stick with it. A plan might look something like this. I have X number of dollars to invest. I am going to invest on the first day of each month for the next 4 months, 5 months, whatever it is, equally until I'm fully invested. That's called dollar cost averaging. It's a very simple technique to get yourself invested and get over the psychological hurdle of today might not be the best day. It might not be the best day, might not be the worst day. But if you put that plan in place, you can dollar cost average, you can get invested. And if you do it over 4, 5, 6 months in the long history of your life, that's not even going to show up. That's going to be as if you did it all at once. Okay, let me keep looking at the charts. Thank you. Okay, hang on. When I said the charts, I meant the questions here. Okay, hang on. Well, this is a very touchy screen. Okay, Ms. Tompkins, you asked about Gilead Sciences. I apologize. I don't have an opinion on that. I'm sorry, I have to pass on that. But how do you feel about investing in Europe right now? Okay, great question. Thank you. Love it. Here's why. What I just said a minute ago about, I'm not going to convert. I'm not going to proselytize folks to go from, active to passive. There is a huge argument right now. We have it in our firm all the time. Should we be exposed internationally or not? From an academic book point of view, yes, you're supposed to be geographically diverse. However, if you look at the last 5, 7 years, there's been no question that US stock markets have just blown the doors off of international markets, okay? And there's no real reason to suggest, well, there actually is a reason to suggest that that's going to change, because what happened over the last 5, 7 years is that the most earnings per share growth came from those beauties, Microsoft, Apple, technology. That's where growth in earnings was. And that is centered in the United States. Whereas Europe is far more cyclically oriented in those sectors that I told you I really, really like, which I'm going to scroll down to again, just to kind of make the point as I'm talking here. These are the sectors that we like right now, early in an economic expansion. And I know I was speaking about a US economic expansion, but the US is the growth for economic growth worldwide. And frankly, again, going back to this horrible tragedy, it will end. It will end at some point in time. And there's going to be a tremendous amount of rebuilding in Ukraine. And it's going to be sponsored in part and financed by the whole world. Okay. I don't want to make too many projections on specificity there. There's lots of unknowns, but there is likely to be economic growth across the world that favors these sectors, which are overexposed in Europe. So yes, you should have some international exposure, including European. We do, and I do overweight US equities, of course. All right, let me continue to get these questions. I don't know if you can see the chat box as I'm doing this. If you can see that it's awfully touchy. So that's why it's taking me some time. Okay, with stocks, the difficult part is when to sell more than when to buy. How do you determine when to sell? That's a great question. It's a fabulous question. Sell discipline, and it is a discipline, is one of the most important things that a portfolio manager can show. I want to tell you that sell discipline doesn't just mean that a stock goes down, you sell it. I know a lot of people who behave that way. It's okay. I'm not criticizing them. I understand that mentality. But when a stock that you have developed a long-term investment thesis in goes down, you have to ask yourself a very important question. Are you, the stock picker, portfolio manager, wrong? Or is the stock market wrong? And I can tell you, it happens both ways. With experience, you learn when it's you and when it's not the market. Now, let me tell you a few tricks here to the trade. Earnings. Earnings, when they come out, are an incredible window into how a company is doing. I make it a point that for any company that I own, I know exactly, numerically, quantitatively, what I am looking for in an earnings report. And I look at the earnings report against my expectations, and I decide based on that whether the stock is doing well or not. That is, as opposed to what I see a lot of people do, is the earnings report come out and they look at the aftermarket share price reaction or the next day's share price reaction, and they judge whether it was good earnings report or not based on that share price reaction. If you do that, you are just setting your course by the passing lights of any ship that goes by you. It's not an investment discipline when you're doing that. I'm going to give you a case in point. And I'm also going to give you a case in point where I was wrong. Okay. Recently, Viacom CBS, which is now called Paramount, which is one of the streaming stories, one of the streaming companies. Recently, they produced earnings, and I knew exactly what I was looking for going into that earnings report. I was looking for how many subscribers were they adding, how many are they projected to add, and what are their revenues going to be from those subscriber additions. And the numbers just were fabulous. They amazed me. I was ecstatic. The next day, the stock was down 20%, 20%, not 2 or 5%, 20%. And I got called on the show. If you've watched the show, you know it can be a crucible. And I got kind of lit up for it. Hey, Lebenthal, you were recommending this stock, and now it's down 20%. I very strongly leaned in and I said, the market is getting it wrong. I could do that because I knew what I was looking for and I got it. And I know that the market sometimes is capricious. And so I said, this is a time to add to it. I added to it. It has since more than recovered and is above where it was prior to those earnings, even as the market has gone down. So that's a case where the market gets it wrong. And if you've done your analysis, you can step in. Sometimes you just get it wrong. I don't want to pick on a stock. I really don't. But I have to give an example, right? Intel. I really want to love Intel. And for many years, it did great for me. And I'm sorry if there's anybody who's invested in it now or works there. I know I'm speaking in Silicon Valley. I really like Intel, and it will turn it around. But the basic truth of the matter is, over the last 3 years, there have been some difficult management changes. And those management changes have either been the tail or the dog that has resulted in operational challenges. The operational challenges are there for everyone to see. I stuck around too long, believing that those operational challenges would turn around. After too many earnings reports in a row of seeing the operational challenges and falling behind on next generation chips, I sold. It was down and I sold it. And I've got to tell you, after I sold it and I admitted to myself that I was wrong, I felt great. good news is I've been wrong enough that I know the catharsis that comes when you just admit you're wrong and you move on. The other good news is, not everybody's right all the time, but I'm right enough to make up for the times I'm wrong. Okay, continuing on here, trying to get these chats. I also want to just take a quick look at the time. 12:47. Bill, Celia, let me know if you think I'm taking too long here.
No, we could definitely take up the entire hour and then a little bit more too.
Oh, good, because these questions are so good. I mean, you guys are really exciting. Okay, this question, we're going to leave it up here. Do you worry that the 7.9% inflation could stay high or go even higher, leading to stagflation hurting the stock market? Okay, the reason I think this question is so good is because remember what I said about stock picking. You want to find something where the market doesn't know it or the market you think is wrong. Now, I know I speak demonstratively, folks. I know that, okay? I really do feel humility inside, and I'm not saying that I'm absolutely right, but here's what I look at. I look at a market that has, for the last few weeks, been freaking out about inflation. Okay, and why not? I mean, West Texas Intermediate shot up. We see what's going on with food prices. We understand what's going on in Ukraine with regards to wheat production and all sorts of, neon gas for semiconductor production comes from Ukraine. I could go on and on. There's a reason for the market to have been worried. My tensive verb there, to have been worried. But what the market's doing right now, what it's not seeing, but which can be seen if you look, is that underneath Ukraine, inflation was set to roll over and may well be rolling over. Now, I'm not saying we're going back to 2 to 3% inflation next month. No way. We're going to get a CPI next week for the month of March that's going to be bonkers. It may well be over 10%. I want to point out to you that was March. That was March. We're now in April. We're moving into May. What's been going on? Okay. What's going on is labor force participation rate is picking up. That's vitally important. That puts a cap on wage growth, which is one of the most important factors in inflation. Also, supply chains have been unclogging. Now, this is a nuanced comment. Please bear with me. The ports of LA and Los Angeles and Long Beach have been seeing those ships waiting outside go down. Why is that? It's for a lot of reasons, but it's because of one of the positives that doesn't get noticed right now, which is that COVID, at least here in the US, has been on the wane. Here's the nuance, and somebody's going to point it out. Yeah, but what about China and Shanghai and Shenzhen? And absolutely, there's a problem in China right now. The last 2 years have shown that those problems resolve themselves. They do the zero COVID and then they reopen. And yes, that does mean that there's going to be a wave of ships coming from China and hitting the ports of Los Angeles and Long Beach. I don't know when, probably June, but that's not the height of shipping season. The third quarter is the height of shipping season when goods have to come over en masse in order to fill the shelves for the holiday shopping season. Second quarter is not a time that you worry about it. And the economy right now is shifting from stay at home, buy on Amazon, to get the heck out. Let's go to the Santa Monica Pier. Let's go to Las Vegas. That's what's going on right now. So that China shutdown is not going to be as impactful as it has been. So for all of these reasons, I think there is a likelihood, and this is bold, it's predicting the future. I might be wrong, okay? But I think there's a likelihood that here's the cadence for the next few weeks. You get a breathtaking CPI on Tuesday, and the markets may freak out a little bit about that. And it gives the Fed cover to do what we know they're going to do. They're going to raise 50 basis points on May 4th. I think that's the date of the announcement. I'm pretty sure it's May 4th. They raise 50 basis points. Their next meeting isn't until mid-June. They get CPI and other inflation readings. By the way, they don't just key off of CPI. Their preferred measure is the PCE deflator, but they also have other indications of what's going on with inflation. They get 2 months basically worth to see if those underlying trends in inflation do come through. But what I'm submitting to you, one person's opinion, is that inflation has been ready to roll over and the market isn't paying attention to it. Love that question. Thank you for getting me excited too. Mr. Fruin, so I would index for the core and stocks for my fund money. I can live with that. I think we discussed the indexing earlier. And again, I just want you invested. If the bulk of it, the core is in indexes, and you have a little fun on the side, the so-called playground account, go for it. But quality companies, please, quality companies. Okay. All right, Nancy, do you individualize each portfolio for your clients, or is there a cookie cutter group of stocks that are presented? Well, I'm not sure I like the term cookie cutter. It implies a lack of thought and energy, but you can't individualize too much because of the old adage, which is true, a jack of all trades is master of none. I run a portfolio of stocks. It's roughly 25 to 30 stocks, which, by the way, is pretty concentrated. Most folks run stock portfolios 50, 60. 25 to 30 stocks is my way of saying I am picking stocks. I'm an active investor. It is not cookie cutter from the point of view of a client can come to me and say, as an example, I don't want any fossil fuel companies. Fine, I get that. You know, I have a team that can modify and make some restrictions. But what I don't do, and I think there's going to be a question, I think I saw it earlier about another stock. What I don't do is just because somebody's got a particular interest in, I'm not picking on Gilead or AT&T, which are a couple of the names that have come up in the discussion. I don't then give an off-the-cuff thought that, sure, AT&T, you know, the dividend cut's already been in there and it's a high dividend yield. Why not? Let's put it in there. That's what's called being a jack of all trades, master of none. So there is a uniformity to my clients' accounts because that's my best thinking. But I do allow a little bit of restrictions for those folks who say, I don't want this type of company. Okay, let me continue on here. How you build and analyze a tech stock portfolio of stocks, say that include Qualcomm, Salesforce. What is the optimum number of tech stocks to hold to ensure sufficient diversification? Very, very good question. And, you know, I did not want to make this a sales pitch for the portfolio that I run. I do have that sales pitch, by the way. In that sales pitch, one of the things that I talk about is sector allocation. And I alluded to this earlier when I said that, I think I said this, maybe I just had it in my head. I think I said that there are some people out there right now who are crying that this, sorry to use the word crying, but they're crying that this is a bear market. One of the luminaries on CNBC has been doing that. It's a bear market. It's a bear market. No, it's not. No, it's not. The S&P 500 went down peak to trough 13%. That's a correction. A bear market is more than 20%. We're well off those lows, by the way. A bear market is 20%, and it grinds on for quarter after quarter after quarter. We're not in a bear market. But if you were not diversified amongst industry sectors, it can feel like a bear market, or it can feel like a bull market. The folks who are saying it's a bear market simply were over allocated to tech. Now, I told you earlier, I like large cap tech. I don't think it's going to blow the doors off of the overall market returns, but it's going to give you the market returns. I also told you that I think those earnings-free stocks that are measured on price to sales, that you should hold those in very small amounts in your portfolio. I didn't say none of them, but very small amounts. The main point I'm driving at here is please take a look at the sector allocation across the S&P 500. What I do with my team is we make a decision that we're not going to be too over or underweight. We will be plus or minus 5 percentage points to the S&P 500 sector weightings. Where we are right now, apropos of what's on this page right here, is overweight industrials. We're overweight financials. We're overweight materials. We're overweight energy. We're underweight utilities and staples. Utilities and staples are defensive. We still own them, but we're underweight them. That means the last couple of weeks haven't felt too good because those are the two sectors that have rallied the most. But if you're early in an economic cycle, those aren't the defensive areas are not where you want to be. Okay, let me continue on here. This is a good question. Is it too late to buy energy stocks such as EOG? I don't have an opinion on EOG. I don't think it's too late to buy energy stocks, but this is a sector that would be great for dollar cost averaging. I would not go into the energy sector and just load up right now. No way. Take your time over the coming months. There's likely to be a lot of back and forth on energy prices and these stocks. However, it is clear that the world is in a supply deficit. The world is in a supply deficit in fossil fuels. I would love to be in a clean energy world. Who wouldn't? I would love to be there. The simple fact, and it's a fact, it's not an opinion, is that you need fossil fuels to get there. There's just no way to mine the minerals to build the wind turbines, the solar farms without fossil fuel energy. So this supply-demand mismatch was occurring before Russia invaded Ukraine, and it's only gotten worse since then. So energy stocks are, as I said earlier, and as I have on this slide, an area that we're overweight. And I do think, though, you have to respect the move that's been made already and dollar cost average your way into it. What's your recommended asset allocation? Mr. Luna, I'm sorry, I cannot give you a set answer to that question because every client is different. I think the most important thing in answering this question, though, is you should have a trusted advisor. Now, that trusted advisor may take any of a number of forms. It doesn't have to be me or my firm, and I'm not pitching me or my firm. But you should have a trusted advisory firm that has experience telling you and helping you figure out your goals, your desires, your fears, your concerns, and expressing that with an asset allocation. The worst mistake that can be made in a asset allocation is taking on too much risk. That's the worst mistake an advisor can make for a client, because that runs the risk that when the market turns down, as it inevitably will, that the client says, take me out, sell, I can't take it anymore. And what that does is it takes a temporary loss and makes it a permanent loss of capital. And again, I point to that chart, that 100-year chart. Okay, let's look at time. Okay, how about this? Because I do feel like my voice is getting a little scratchy. I'm going to go another 10 minutes. Is that okay? And then we can transition to Bill. Is that okay?
That would be great.
Okay, thank you. Thank you very much. Okay, continuing on here. If we have a short time horizon in a taxable account, what do you recommend holding? Short-term munis, park in a money market fund? It's a good question, Mr. Roman. 0 to 2 years is actually a very short time frame. And I think you know that. I think the way you phrased the question obviously implies that. 2 years or less is a short time frame. Anything can happen in the stock market in 2 years, meaning you could invest today in 2 years, it could be lower. It could be lower. 5 years, highly unlikely. 10 years, super duper unlikely. Okay, and I have data to back that up. But 0 to 2 years, I'd like you to have a little bit of stock allocation, but I really do think that you should be in short-term bonds, munis, as you point out, if you're taxable, or taxable bonds if you're in a tax-free account. And the point really being is that the duration of those bonds should match the time frame involved in your projection. How much would you be ahead if you avoided the 10 worst days in the market? Where would you be if you avoided the 10 best and worst days in the market? Richard, it's a good question. I don't have the answer for you, but hang on one second, because I just want to go back. It's a good question, and I don't want to give it short shrift. It's a question that comes up often. Where did that go? Hang on. Comes up often in this discussion. My answer to you, I think there's an implication in the question that, forget what I'm saying on the right-hand side, because you know, by market timing, you could miss the 10 worst days as well as the 10 best days. I think that's implied when I hear other people at least say that. And what I would point out to you, that these numbers for the returns are positive, okay? And what that strikes me as saying is that you are more likely, if you're timing the markets, to miss good days than the bad days. That the impact of market timing is more likely to be negative than positive. I will tell you this from firsthand experience. When I was younger, and I refer to this because I can say things with an authenticity now that experience gives me. When I was younger, I let a client or two market time, and I watched them destroy their wealth, okay? I watched them say, take me out of the market because I don't like the president that's been elected. Okay. And then the market rallies, and then they're panicked. Get me in the market, get me in the market. And inevitably they reach that conclusion at just the wrong time. And then the market goes down, and we're in this horrible chasing a dog's tail. It's terrible. I have now gotten to the point where when clients ask me to do that, I very politely say, I want to be your advisor. I'd like to be your trusted advisor and even your friend, but I can't do what you're saying. And if that means you have to find another advisor, I understand that, but I've just seen too much wealth destroyed by market timing. I'm sorry if I sound sanctimonious. I don't mean it that way. I mean to say that this is what I believe. All right. Okay. Somebody said their dog meets more interesting people than me every day. Oh, okay. not than me, I don't think. Okay, hang on. I just found that amusing. Thoughts on Latin America? I'm sorry, I don't have them. Ooh, Mr. Abel, what a good question. If we may get only 9.7%, why not go with triple leverage SPY fund like SPXL? Actually two big reasons. The first is those leveraged funds, those triple X to the upside and downside, they're not investing in stocks. They're investing in futures on the stock market. And there is a large degree of tracking error when you use futures in one of these funds, as opposed to the underlying stocks themselves. And if you want to see this in person, just go take a look at a chart 10 years or so of the VIXY, VIXY, which is the volatility index, versus the VIX that it's supposed to track. The VIX over time goes up and down, but it kind of stays in one area. The VIXY over time goes down. These things, I mean, listen, I'm going to quote Warren Buffett: futures, which are a form of derivatives, are weapons of mass destruction in finance area. I apologize for the sanctimony. It's not what I mean to be. I just, those things scare me. Okay. All right, let me continue on. Opinion on AT&T. Oh boy. I said I wasn't going to be a jack of all trades and master of none, but Nancy, I'll give you an opinion. Okay, because you asked for it. AT&T, I get the valuation, I get the dividend yield. Honestly, I'm worried. Okay. This is a heavily indebted company going into a high CapEx cycle that they're going to take on more debt. Okay, the 5G cycle. And then on top of that, they're locked in a price war. Do you see these commercials from T-Mobile and AT&T and Verizon? They want to give you everything to become a customer. That's not, whoa, remember that term I used earlier, moat to competition? That's what the opposite of a moat to competition looks like. Okay, Nancy, I'm so sorry, because that's so negative, but I'm worried about AT&T. I'm starting to sound like Jimmy Cramer. I don't want to do that, but okay. What are your thoughts on bond funds for diversification? They're taking a big hit right now. Yeah, this last quarter has been interesting, where both bonds and stocks go down, and that's not usual. I think bond funds for diversification matter. What they do is they smooth out the overall volatility of stock market returns, which I said are going to be high and going higher. The inclusion of bonds smooth out your overall portfolio returns, but they're going to detract from your overall returns, right? Because they're returning less than what I project the stock market is going to be. The trick is finding the balance between bonds and stocks. And I really recommend finding a trusted advisor to help you with that. Okay. With bonds getting hammered, I love it when people use the word hammered. This stock's getting hammered. Bonds are getting hammered. I love it. It's provocative. It's a provocative word. Where does one go for a safe harbor for their portfolio? Now, I'm not making fun of the use of the word hammered, because you know what? Bonds did get hammered this year. They have gotten hammered. I get that. They have. Ultimately, there is only one safe investment, and that is cash. That is treasuries. So, I mean, the short answer to your question is go to treasuries. The 10-year treasury is yielding 2.7%. And while I don't think that's very high, it is much higher than where they were just at the beginning of the year. Beginning of the year, 10-year treasuries were 1.5%. You could buy some single A, double A rated corporate bonds, probably get it up towards 3.5% on 7-year paper. But that's, you give up return when you look for safety. Under what conditions would you advise a client to add to their portfolio alternative investments, such as private equity, venture funds, or crypto? And I love alternative investments. My firm is very strong in them. That said, I am a public equity analyst, portfolio manager, and strategist. I love public equities because they can give good returns with liquidity. Private equity, venture funds, crypto can give very good returns as well. They're just not always as liquid. Part of the appeal of them, though, is that their returns are usually uncorrelated with that of traditional asset classes, and it can smooth out the returns overall. Okay, I want to check time here. I'm going to take 2 more questions, and then I think my voice is ready to give out. What would need to happen for you to turn bearish? It's a really good question. Really good question. A few things would have to happen. I'd have to see a crack, at least one, in the labor market. I don't see a crack in the labor market anywhere. I really don't. I mean, jobless claims this past week were 166,000. That number is breathtakingly low. We know that companies want to hire right now. It doesn't matter what company you're in. Companies want to hire right now. I would have to see a crack in the labor market because our economy, which again, growth engine of the world, is 70% consumption. People will consume more when they have a job than when they're on the government dole. They just feel better about things. They consume more. So I'd really need to see a crack in the labor market, and that would perhaps be a premonition that earnings based on consumption were going to go down. But that's really what I'd be looking for right now. Okay. I just want to get one more good one. Ooh, I think I'm sorry. This is my screen is so sensitive, but I think I saw one about electric vehicles. What's your outlook on electric vehicles in general? What's your outlook on electric vehicles in general for a 5-year outlook or more? For instance, Tesla seems stable, NIO as well, yet its stock market is tanked. Lucid can't mass produce yet, and so on. Okay, my prediction is that the electric vehicle market is where automobiles are going. All right, and if I look at General Motors, they said they're going to not be selling legacy internal combustion engines next decade. And if I look at Tesla, I see a fabulous company with its cars all over the road. I've signed up for one of the new GM electric vehicles, which I hope is going to come out soon, the Lyriq. So I'm ready to go. I am ready. I'm ready. The sector, as a stock sector, got way ahead of itself last year. It just did. These companies like Lucid, okay, had a per car valuation, per car production valuation of around $3 million versus General Motors at about $69,000. The sector got overvalued and has since really corrected. And I think this is a time to look at which companies are likely to survive, going back to quality company, good management, most competition, balance sheet. A moat to competition, by the way, in automotive is scale and the size to produce. That favors Tesla and General Motors and Volkswagen. It doesn't favor Lucid. Okay, with that, I think I am going to call it quits for today. Celia, can I send it back to you and Bill?
Yes, that would be great. And thank you so much. Most of us are on the West Coast, so we thank you for waking us up this Saturday morning with your very energetic and insightful presentation. We really hope that you'll come back and give us an update another time.
Okay, happily. Thank you for having me. This has been a great fun.